The early 20th century witnessed a manufacturing revolution, and at the heart of it was Henry Ford's groundbreaking assembly line. This innovation demanded a new approach to cost accounting, one that could handle mass production and provide consistent cost control. Enter standard costing, a system pioneered by Ford Motor Company in the 1920s to track and manage the costs of producing its iconic Model T. Standard costing, in its essence, is a system that predetermines the cost of producing a single unit of a product or service. This standard cost is derived from carefully calculated estimates of material, labor, and overhead expenses. Imagine it as a recipe for cost accounting. Just as a recipe lists the precise ingredients and quantities for a dish, standard costing outlines the expected costs for each element of production. This revolutionary approach transformed manufacturing cost accounting. Before standard costing, businesses relied on historical cost accounting, which often provided delayed and inaccurate cost information. Standard costing, in contrast, offered a proactive and standardized way to measure and control costs, enabling businesses to optimize production processes and improve profitability. The adoption of standard costing by Ford and its subsequent success quickly made it the industry standard. It provided a much-needed framework for managing the complexities of mass production and paved the way for the efficient manufacturing practices we see today. To understand the mechanics of standard costing, let's break down the process into digestible steps. First, we need to establish the standard for each cost element: direct materials, direct labor, and manufacturing overhead. For direct materials, this involves determining the standard quantity of material needed per unit of production and the standard price per unit of that material. Direct labor standards are set by estimating the standard time required to complete a unit and the standard wage rate for that labor. Manufacturing overhead, which includes indirect costs like factory rent and utilities, is allocated to products based on a predetermined overhead rate. Once these standards are set, the total standard cost per unit is calculated by adding the standard costs of materials, labor, and overhead. This figure serves as a benchmark against which actual costs are measured. The real magic of standard costing lies in the continuous comparison between these standard costs and the actual costs incurred during production. This comparison allows for the identification of variances, which are simply differences between the standard and actual costs. Variances can be either favorable, actual costs are lower than standard, or unfavorable, actual costs are higher than standard. By analyzing these variances, businesses can pinpoint areas of inefficiency, identify potential cost savings, and implement corrective actions. The cyclical process of setting standards, measuring actual costs, analyzing variances, and taking corrective actions forms the core of standard costing. This iterative approach provides businesses with a robust framework for cost control and performance evaluation. The enduring appeal of standard costing lies in its ability to bring order to the complexities of manufacturing, especially for businesses with intricate production processes, large-scale operations, or diverse product lines. Standard costing offers a number of compelling advantages. Firstly, it simplifies cost accounting by providing a standardized framework for cost measurement and reporting. This consistency makes it easier to compare costs across different periods, departments, and product lines. Secondly, standard costing facilitates cost control by setting benchmarks and enabling the identification of variances. This allows businesses to proactively manage costs and improve operational efficiency. Thirdly, standard costing aids in inventory valuation by providing a consistent basis for valuing inventory. This is crucial for accurate financial reporting and decision-making. Fourthly, it facilitates performance evaluation by setting clear performance targets and enabling the assessment of operational efficiency. This helps identify areas for improvement and reward exceptional performance. Lastly, standard costing streamlines budgeting and forecasting by providing a reliable basis for estimating future costs and setting realistic budgets. This improves financial planning and resource allocation. Despite its age, standard costing remains a valuable tool for businesses seeking to gain greater control over their costs and improve their bottom line. Section 4, the limits of standards in a changing world, unveiling the drawbacks. While standard costing has proven its worth over decades, it's not without limitations. The business landscape of the 21st century is vastly different from the manufacturing environment of the early 20th century. Today's businesses operate in a rapidly evolving market characterized by technological advancements, shorter product life cycles, and increasing customer demand for customization. These factors pose challenges to the traditional model of standard costing. One major drawback is its reliance on static standards. In today's dynamic environment, costs of materials, labor, and overhead are constantly fluctuating. Setting fixed standards for these elements can lead to inaccurate cost calculations and misinformed decision-making. Moreover, the increasing automation of manufacturing processes reduces the relevance of direct labor as a primary cost driver. Standard costing often struggles to accurately capture the complexities of automated production environments where overhead costs play a more significant role. Furthermore, the traditional focus on cost minimization can sometimes come at the expense of other important factors like product quality, innovation, and customer satisfaction. In an era where businesses are increasingly driven by customer centricity and rapid product development cycles, standard costing's emphasis on cost control may not always align with these strategic priorities. Lastly, the process of setting and maintaining accurate standards can be time-consuming and resource-intensive, particularly for businesses with a wide range of products or complex production processes. Section 5. When costs don't add up, understanding variances and their impact. As we've explored, variances are at the heart of standard costing, highlighting discrepancies between predetermined standards and actual costs incurred during production. While variances provide valuable insights into cost fluctuations, understanding their nature and potential impact on financial statements is crucial. Favorable variances, where actual costs are lower than standard costs, might appear positive at first glance. However, they don't always tell the complete story. A favorable material price variance, for instance, could indicate efficient purchasing practices. Conversely, it could also point to the use of lower quality materials, potentially compromising product quality in the long run. Unfavorable variances, on the other hand, warrant closer scrutiny as they signal potential areas of concern. For example, an unfavorable labor rate variance might suggest increased labor costs due to a shortage of skilled workers. Alternatively, it could indicate inefficient production processes leading to wasted labor hours. The impact of variances extends beyond the realm of cost accounting, directly influencing a company's financial statements. Material and labor variances, for example, directly affect the cost of goods sold, ultimately influencing gross profit margins. Similarly, overhead variances can impact operating expenses, impacting a company's net income. Accurately analyzing and interpreting these variances provides valuable insights into a company's operational efficiency and profitability. Section 6. Beyond standard costing, embracing the future of product costing. While standard costing has served businesses well for many years, the evolving business landscape demands a more dynamic and adaptable approach to product costing. Several alternatives and enhancements to traditional standard costing have emerged, driven by technological advancements and changing business needs. One such alternative is activity-based costing, or ABC, which allocates overhead costs based on activities rather than traditional volume-based drivers. ABC provides a more accurate reflection of overhead costs and enables better cost control by identifying and eliminating non-value-added activities. Another approach is lean accounting, which aligns with the principles of lean manufacturing and focuses on eliminating waste, improving flow, and maximizing customer value. Lean accounting emphasizes value streams rather than individual products or departments and uses simpler metrics to track performance and drive continuous improvement. Advancements in data analytics and machine learning are also transforming the field of cost accounting. Predictive modeling, for instance, utilizes historical data to forecast future costs, enabling businesses to anticipate cost fluctuations and make more informed decisions. Data-driven insights can also help optimize pricing strategies, manage inventory levels more effectively, and identify potential cost-saving opportunities. The future of product costing lies in embracing these evolving methodologies and leveraging technology to create more accurate, relevant, and insightful cost management systems.